Welcome back, friends, to Morning Trade Live. So glad you're with me. It's time to go inside out on industrials. Joining me right now, Jonathan Sakraida is with us, VP Equity Research at CFRA Research. Thank you so much for being with us, Jonathan. We'll start with Honeywell, which is up about 4%, helping to propel the Dow higher, up over 100 points for the Dow. Overall, the Dow's up over 100 points, but Honeywell's contributing. What stood out in the report to you?
Good morning, Nicole. Thanks for having me. So very strong quarter. This is a pretty good day for Honeywell investors. What stood out is, as you said, for SoFi Technologies, right, a beat and a raise is pretty remarkable in this current environment. And that's what we got with Honeywell International. A very strong beat to top line, over $200 million higher than the consensus, a beat on earnings, as well as a raise from the lower end of guidance, which is very remarkable, especially for industrials, where we've seen a lot of reaffirming targets, but not much in way of raises. So I'd say really just the amount of confidence as far as management's tone on offsetting tariffs. I think we've really seen a transition in global supply chains in recent years as far as de-risking to avoid some of the headaches we saw in 2021, 2022. We're seeing some of the fruits there being bared on supply chain management today in Honeywell's earnings print.
So is Honeywell a standout in the industrial sector, or are there several, and we're going to get to Caterpillar in a moment, but is the industrial sector a sector that could do well in light of the current situation, whether it's tariffs or economy?
Even before tariffs were implemented, we had a pretty strong view at CFRA that really a lot of industrial firms would do quite well is offsetting tariff impacts to the bottom line. Keep in mind that the trade war has really picked up in 2018. Then you had in 2021, 2022, global supply chain crisis spurred by the COVID pandemic. So for the past several years, there's been a shift to what's called local for local manufacturing, where manufacturers produce goods where that end market consumer is. As well as dual sourcing, so making sure they're not overly exposed to just one country as far as getting the proper components and materials, particularly China. We've seen in trade data a lower reliance on China since 2018 as far as their importance as a trade partner. And a lot of this is also being fleshed out by industrial firms. So I think really broadly, we've seen a lot of confidence from industrial firms as far as offsetting impacts from tariffs in the bottom line. Now, as far as demand, that's a different story. There's a lot less visibility there. That's not something that industrial firms can control. They can control how they adjust pricing and how they resource certain components and materials. But as far as demand, we'll have to see how that shakes out later in the year. Obviously, if we were to enter a recession due to just a complete lack of trade deals, then that would really change the story here. But as of right now, it's a great start to the year for industrials and a lot of confidence as far as defending margins.
Understood. And where does Caterpillar fit into the big picture, and what do you expect to hear from this company, which right now is in 6 months down 20%? Well, I should say 3 months. It's 3 months. It's down 20%.
Right. Caterpillar's had certainly hit a rough patch. We've seen a lot of revisions lower on their guidance. So in contrast to Honeywell, we've had a buy in Honeywell. We like their portfolio transformation potential as far as unlocking value. Caterpillar, we've had it at a hold. We're kind of neutral to bearish on the name. Really, demand has just really failed to materialize for Caterpillar. They've certainly kind of hit a more resistance as far as cyclical headwinds for the demand for large capital equipment. Now, we have actually rated a competitor, or at least adjacent company, United Rental, as a strong buy, because we think this higher interest rate environment really does lend to demand for rentals over the commitment of capital to purchase outright. So we do think there's been some market share loss there to rental firms as far as completing construction projects in kind of an uncertain macro environment, coupled with higher interest rates.
So United Rentals, URI, is at 625 today. You mentioned you have a strong buy on it. What's your price target on URI?
$825 right now, so a pretty good amount of upside from here.
Wow.
And really, it's almost entirely exposed to U.S. markets, so it doesn't really have to worry as much about demand destruction in terms of overseas. So we think it's a good name as far as insulation from tariffs, relatively speaking. As well as, like I said, we believe there's some market share take right now, as there is a growing preference towards rentals over outright purchases, kind of taking away from Caterpillar's growth.
Very interesting. Okay, strong buy on United Rentals, the buy with the 245 target on Honeywell, and a hold on Caterpillar and 390 target. Jonathan Sakraida, great to see you from CFRA Research. Jonathan, thanks for those names today. Good look at those industrials. And now we're going to trade it with Tom White, host of Fast Market. Good morning to you, Tom White. You're watching Honeywell closely. I mentioned what a winner was. We were saying it's unusual to see these companies with beat and a raise. How would you go about trading a name like Honeywell?
Well, the first thing you do is, it's having a nice little pop here today, still off about 15% from those recent highs. I don't think it's immune to maybe pullbacks in the overall market. And I think that's a concern for every stock this earnings season. So even though we're seeing the nice pop, I think you want to be cautious on this one. And that's the way I looked at this from an example trade perspective, where I went out a few weeks out to the May 23rd weekly cycle. So just about 3.5 weeks to expiration, and taking a bullish stance, but at the same time remaining conservative on this type of strategy. Selling a put vertical, sell the 205 strike put out of the money to the downside. And then to make it risk-defying, because we all know that things can get a little bit hairy here during earnings season, buy the 195 strike put against it. So a short $10 wide put vertical, you're going to collect roughly about a $250 credit on it. That's what you can make. $250 per spread with $750 in risk. But it takes your break even all the way down to 202.50 to the downside. That's about 4% below the current share price in Honeywell. So while it's still a bullish stance type of strategy, you're giving yourself that nice cushion to the downside before you get hurt on a trade like this.
All right, and last but not least here, you're trading Caterpillar, and that's ahead of the report for tomorrow, a name that has been beaten down. It's 20% off in 3 months. Some of your thoughts there?
Yeah, in bear market territory going into this report. The option market's pricing in about a plus or minus just over $15 move either way in the stock, so about 5% either way. You have to wonder what they're going to say, and the commentary is going to be around the tariffs, especially out of China, as they provide a lot of machinery over in Asia. So that's going to be a concern for this company, but maybe the pullback that we've seen in the stock from those all-time highs in November is already taking place here, right? So I looked at a strategy. If you're bullish on this name, this is the type of strategy that works out, and it takes advantage of volatility dispersion between the different option series. So going really short-term positioning, going out to the November 9th weekly cycle, so 10 days to expiration. We're going to buy something at the money, the 305 strike call. That's got that higher delta, reacts more like the stock. And then in the near term, May 2nd weekly options that expire in just 3 days, we're going to sell the 320 strike call. So it sets up right with that one standard deviation move where you want this stock to go at or near 320 or just higher, right? $15 wide bullish call diagonal. You're paying roughly about an $8 debit for it, so almost half the width of that spread. So why is that? Well, it's that vol dispersion I talked about where you're buying 48% implied volatility on aggregate in that May 9th weekly 305 strike calls, and then selling about a 73% implied volatility in the May 2nd weekly options on that 320 strike. So that vol dispersion or differential actually lowers the price input, and that lowers your risk, which is about $800 per spread. Now, where do you start to profit on a strategy like this? It's about 310 to the upside on this one. So anything above that level is going to be profitability on this type of trade. Now, if you're bearish on this one, it's all about the strategy. Maybe you want to buy a put diagonal instead using those same option series to take advantage of that dispersion. But this example is just a bullish trade where if you think this thing is going to go higher about that one standard deviation or more, this takes advantage of it.
Understood. And as you mentioned, in bear market territory, so maybe it has a chance for that. Thank you for those example trades there.
Thanks.
Tom White, nice to see you. Thank you.